I'm delighted to be joined by our three guests this morning. And I'd like to start by talking about the Fed. We've all been talking about it and reading about it for the last few days. It kind of seems to have been top of the headlines in terms of the statements made a few days ago that the Federal Reserve in America is considering bringing interest rates up ahead of by 2023, contrary to previous announcements and expectations. That riled the markets a little bit, not necessarily just the oil markets, but the stock markets. And last night, the Fed seemed to be kind of trying to backtrack a little bit from what they said a few days ago to kind of try and allay any fears of sort of early intervention, if you like. Albert Stromquist from Landstrom Advisors, welcome to the show. This is your first time joining us. Thank you so much for making the time.
Thank you, Diala. Thank you very much. It's a pleasure to see you.
And I'd like to go to you with that sort of global aspect of what the Fed's planning to do and how that's going to impact economies, etc. What do you make of the Fed last night sort of trying to kind of retract on its more hawkish posture? Do you think there's they were right to do that?
I think they sent some very serious ripples with the chairman's earlier comments several days ago, leading the markets to anticipate interest rate increases of unknown magnitude beginning in 2023. Two, I believe, is what they referred to. You had a speaker 2 days ago on one of these Silk Road panels who made an excellent point, and that is that the U.S. debt, now standing at about $28 trillion, right, cannot stand an increase in interest rates. We're currently looking at about $500 billion annual interest payment on the existing debt, right? And any effort now to introduce an interest rate increase is going to make that debt unmanageable. So the Fed has maybe rethought the strategic consequences of rate increases, unqualified reference to rate increases in 2023, and has thrown a note of caution behind that and said, we will watch the inflationary volatility. We still believe it may be transitory.
Yeah,
but
I mean,
we're not locking in a decision today.
I mean, they've been saying that all along, that look, if the last few months, the sort of fear of inflation, last 6 months we have seen consumer prices rise in the US and elsewhere, doubling. That you could argue we have inflation already, obviously, due to bottlenecks, due to sort of pent-up demand coming back on. There's no argument against that, and yet the Fed has been saying, oh, well, we see this as temporary, as transient, and yet they obviously kind of changed their tune a few days ago. But the point is that we are seeing real consumer price inflation on the ground, and the argument you're making of, oh, it's a disaster if we increase interest rates, because how's that going to be managed with the debt level that has been created? But that is there, that's not going away. So does that mean we're never going to have interest rates? I mean, they're in a bit of a fix, right? I mean, how can they manage the soft landing of this strategy?
Well, it becomes a self-feeding cycle, doesn't it? Where interest rate increases ultimately raise the debt as more debt is required to pay the interest. So it's a bad place to be in economics. The consumer price increases and the one scenario have been attributed to a mismatch between manufacturing capacity post-COVID or coming out of the COVID recovery and pent-up consumer demand. Yeah. So consumers are prepared to pay much higher prices today for a leaner manufacturing output. And the Fed is hoping that that is going to be the transitory component of their forecast.
Okay, thanks, Albert. Rustin Edwards, Head of Fuel Oil Procurement at Euronav, welcome back, our regular guest from Switzerland. Rustin, I'd just like to switch to sort of the oil markets. We're obviously seeing prices very comfortably consolidate above $70 for the last couple of weeks. We seem to be in firm territory there. We have a story on our headline bulletin this morning about volatility. CEOs of oil companies warning that, yes, we're on a positive upward trajectory, but be prepared for a range of $50 to $100 volatility going forward because of the transition argument, because of tight supply, because of lack of investment. Your views on that, and how concerned should the market be about volatility going forward?
Well, I mean, money flow always can trump the physical market at the beginning of any type of cycle, because there's far more dollars being thrown into the front end of price curves, as a lot of investors, a lot of fund managers look at a way to hedge themselves against the inflationary trajectory that we're currently on in the marketplace. I mean, if you look at not only oil, but other soft commodities and metals, there's an upward trajectory across the board, because everybody's looking for that nice yield return. And until you get federal interest rates actually increasing, causing bond yields to go up, people will not pull their money out of high risk assets. They will stay in the high risk space, and they'll keep moving things forward. A lot of the volatility that can happen going forward is the fact you still have the dynamic of the market right now is you've got a highly backwardated crude oil market, yet all of your refined products across the board are a flat to contango market structure, which means that you have oversupply of refined goods for the actual demand profile that's in place, yet crude is far accelerating that. You can see at the forward refinery margins right now are all trending down or negative in some marketplaces. The United States still has the strongest refining margin. A lot of that is because they are far further down the road on their reopening of the economy, better gasoline demand, better jet demand in general. But even in the United States, they're at a breaking point where the refinery utilizations are probably too high for the domestic demand profile. One thing about the United States refining sector is that it is geared for exporting of products to Latin America and the internal U.S. Consumption. And right now, South America, Central America are still in the grips of massive COVID lockdowns and restrictions in travel. So they're missing that piece of the demand for the export of gasoline, distillates, and of course, international jet travel that would normally keep a 90+ utilization rate at in containment. So the thing with the API stats, drawing crude, building products. One thing we'll probably see again today is we'll probably see that same pattern repeat in the EIA, drawing crude, building products.
And so this building products, again, I mean, if we just go across the oceans a bit to China, we also have a story on that this morning in terms of Chinese refineries, and obviously how strong the demand on the imports of crude are there to go into refineries. There's been, I think the Chinese government has partially announced what the quotas are, the second sort of set of quotas for imports. There's a story on our bulletin which says that they haven't quite finished giving 100% of what those allocations are going to be. And so how critical is that sort of last 10-20% uncertainty of what the import quotas might be in China to the demand story, if you like, for importing crude from, obviously part of which comes from the US as well?
Well, in the Chinese point of view, and Albert probably knows a lot better than I do because he's there on the ground, but from our perspective, from the importer side of the coin, if you want to say, there is a reduction in the quota, mainly because the Chinese government is cracking down on tax avoidance and other, issues that were going on internally to circumvent the rules and regulations the Chinese government had put up around import quotas of product and export quotas of products. So with all this tax avoidance regulation coming into play now, the market is going to have to rebalance as to how are the independent refiners going to be able to function in an environment where they don't have the quota to import crude oil, and the alternative feedstocks are taxed at a much higher rate than where they were a month ago.
Do you want to just comment on that from the Chinese perspective of why they're keeping some of their own independent refiners guessing on how much they're going to be allowed to import? I think in August there might be more clarity on that. But is it a tax story, i.e., the recent measures by the government coming down on refiners, or is it?
Well, yeah, it is a tax story. The tax avoidance was unsustainable, and that was a story of blend stock products coming into China unregulated at the rate of about 250,000 barrels a day, I understand. And they were avoiding tax through the import of the blend stocks, mostly from Japan and Korea. Now that gap's been plugged, right? And the unregulated import of the blend stocks led to a huge overhang in motor fuels. which began to choke the system and led to I think an increase in Chinese exports of motor fuels, just to begin to clear inventories. So there is a rebalancing going on here now. I don't see the full story. I think Rustin has covered the answer pretty well.
Okay, thanks, Albert. Andre Bly, CEO at Belsen, welcome back to the show. Andre, I'd like to sort of move on to the OPEC story and the supply side of the equation. We're continuing to see obviously OPEC fully in control of what they're doing. Obviously, they have a meeting coming up very soon, in a week's time, July the 1st, to decide on what they're going to do from August onwards with output. There have been calls in the market for a need for more, obviously, to release more output because of tight demand, tight supply and rising demand. Others are sort of cautioning and saying that OPEC will remain and continue to be cautious, and it has the advantage of doing that, I suppose you could argue. But your expectations for what they might decide on in a week's time, and particularly Russia's angle in that equation?
Yeah, good question. Thank you. Well, indeed, the markets are in a certain area of uncertainty because the demand is rising, but at the same time we see that South Asia and East Asia are again locked in the uncertainty of the pandemic. We may also see that the producers are willing to export more in this context, as there are opportunities in terms of price, but indeed you rightly said that nobody wants another price collapse. So I guess a moderate increase could happen, and in addition to that there are uncontrolled volumes, so OPEC doesn't control everything, and therefore...
You're referring to Iranian oil still sort of going onto the market, or?
And Iran remains quite another point of uncertainty, because the new hardliner president seems to be uneasy to negotiate the deal, and therefore it's not that clear or not that evident that actually Iranian oil gonna go to the market pretty soon. Russian perspective, well, Russia for more than a year, Russia maintained this position that the price has to be higher, even though internally in Russia there are economic forces like smaller oil producers who would like to have more production in this context.
Okay, but I mean now that they've achieved this higher price, obviously that's benefiting those producers amongst others. Are they still pushing as hard for more production, given that they've achieved this very nice healthy price for Russia? It's above even their budget requirements. Will they still be pushing as hard as they were a few months ago for OPEC Plus to maybe ease more oil into the market?
Pushing, yes, but do they have a sufficient impacting factor after the pushing? That's actually a big question. So far, the NOC, Rosneft, seems to be more conservative regarding the quotas, the position which may again change in a week. So it's quite an interesting period for oil markets, because it's all influenced and shaped by a number of uncertainties. We cannot be entirely sure that the demand is going to go up and that actually supply is not going to overlap. But generally speaking, of course, the sentiment is bullish. So I would say the price will still be pushed up, and moreover, what actually colleagues just discussed about difficulties in increasing interest rates basically lead to a further increase in gold price, and therefore in commodity prices in general. That favors oil, which doesn't favor automatically oil producers, because the overall prices go up. Yeah, so the decline of dollar in relative terms means that actually all the equipment costs go up and all the production costs go up.
Yeah.
So increasing price also means increasing costs. But for the consumers, the price is going to go up.
Yeah, and I mean, we are, as you said, we're looking at a bullish trajectory for prices on the whole. I'd like to talk a bit about shale oil, as we do every week. You know, we're still, Rustin, if I can go to you first on that, and actually I'm going to ask Irene at the same time to put up our survey question for our viewers, which is on this topic of shale. Rustin, we're now firmly above $70, as we discussed earlier. The trajectory, many fund managers are calling for $80, $90, where I don't think anyone is disagreeing that oil is on its way up. And yet we're still, not really seeing any firm recommitment from shale producers. Maybe they're starting to dip back in. At what point, I mean, we will put that question to our audience. When will we see an evident re-entering of shale producers into the market? Will it be, above 75, above 80? The break-even price is supposedly $50. So what are they doing? Waiting, I know there's the financial pressures that we've all discussed that they're all under, but really, realistically speaking, how much more can they hold out? Rustin, to you.
Well, I actually think we'll start seeing increases in U.S. production this week again. U.S. production did a moderate increase by 11.2. My call is that we'd see 11.5, maybe 11.4, but I think 11.5 this week. A lot of that can be looked at what happened on options expiry in the United States. A lot of shale producers, they hedge with zero cost collars. So they're basically buying the put and selling the call option. As the call options go into expiry, they have to cover their delta. So they have to buy the future to cover that short call position. And as we saw at the expiry in WTI, there were massive inflows to the buy side of the TI contracts going into expiry. I mean, we saw $2 price rallies on New York State Open, New York Market Open, which was just indicating of that gamma coverage that was going on. So the only way that the shale producer can offset that loss on the future is to actually produce the oil, because they need to monetize the physical barrel against that mark-to-market loss on their call option. And so that's where I think we'll start seeing more impetus on the shale producers to get barrels out of the ground into the marketplace because they want to cover that loss.
And how do we expect OPEC would react to that? I mean, obviously, in a week's time they're meeting. They're clearly monitoring this thing consistently. Is it still factoring into their thinking, or, as our survey question just pointed out as one option, they are fully in control of the rest of excess supply, let's say, in the market, and so can do what they like essentially to control that yo-yo of shale coming back or not? I mean, do you feel confident about that?
Well, OPEC can still keep that specter of flooding the market because they still have 5.8 million barrels sitting on the sideline. So if they wanted to price shale out, they could just say, you know what, open the taps, boys, we're done, and the market will drop from $70 down to $50 rather quickly.
Unlikely they will do that, given how
unlikely
we wanted to steady the markets. Really,
I think they just need to see see shale coming back. And one thing in the uncertainty of the shale production is the fact that the Biden administration lost a case in Louisiana against the cancellation or the stoppage of drilling on federal lands. And so that case does have ramifications that it does give the shale producer a little more stability around the regulatory environment that they were all fearing with the Biden administration coming in, declaring that he was not going to allow any more exploration on federal lands. So with that type of regulatory ambiguity out of the equation now, it can allow them to actually make better investments going forward, or better investment decisions going forward, because now they have clarity on that piece.
Okay, and I'll ask Irene to bring up that result for us, that survey, when it's ready, and we can all have a look at it. There you go. Oh gosh, I hate those neck and neck results. It's almost like the software has gone faulty. Well, there you go. Okay, we can average that out and say 7 or 8.
We're basically 2/3 at somewhere between 75 and $80. It's going to happen.
Absolutely, and only 20% believe OPEC will have full control of that. So that's kind of interesting. I'd like to kind of stick to the supply-demand story and talk a bit about demand projections and where we are for the second half of the year. The argument of what depends on what happens with COVID and obviously with Asia and how any resurgence has happened there, and lockdowns in Europe, and America's obviously fully open and back on track. But in terms of jet fuel demand, because that has been the biggie, in terms of, you know, the one that's everyone's still waiting for to come back, international travel, and that doesn't seem to be easing that quickly as expected. Albert, if I can just go to you on that. And there was an interesting article that you mentioned earlier to us out of China about China not allowing travelers into its country for at least another 12 months or round about that. How is that going to impact, clearly it's going to impact jet fuel demand, but how serious do you think that is, the projection?
Well, no, I just read that yesterday myself on the news here. And it kind of shocked me because it kind of means I'm trapped here in China as well. The travel demand for international travel has been chilled as a result of that announcement. Anyone who is anticipating international travel this year now has to put off those plans until next year. The total fuel budget here in China is about 1 million barrels a day, I was reading, of which 800,000 fuels the domestic travel market, which is going strong. The sky is full of airplanes. All the domestic airlines are having a great summer so far, spring and summer, recovering from their income losses from last year. And that has not impacted the demand for travel here in China. But there's another 200,000 barrels a day of budget for international jet fuel, which is a large question mark. And that's a pretty large piece of value, which is now the subject of some uncertainty.
Andre, on the European front, I mean, we see Europe, you know, opening its doors to travel again. There is some divergence between countries. Some are requiring certain vaccines, some aren't, you know, etc. There doesn't seem to be a comprehensive, cohesive policy there, which obviously makes travel within Europe a headache still. But people are getting on planes and planning their summer holidays. Your view on that, the European perspective, how's that looking?
I would not be that over-optimistic. First of all, Europe is open for internal travels, so basically between the European Union states, and there may be some rebound in tourism would happen, but still there are no Chinese tourists, for example. Chinese tourists have been the best buyers in Europe, and that basically gave a lot of fuel for financial fuel. I mean, for small businesses like shops, souvenir shops, cafes, and that still limits quite a lot the recovery. And
but we have all the Europeans instead staying on their continent or in their country and spending their money there instead of going to America or going to Asia. The other side of the coin is you see a lot of domestic expenditure being in.
The domestic has always been there, and it has decreased because the overall financial pressure increased. So the situation is not that easy. And if you, for example, talk to business owners, you realize actually the change is there. And the question is, well, how for a couple of centuries European economies, West European economies particularly functioned, that you had this middle class which didn't need any assistance from the state and which actually could provide some revenues to the state. Now what shall the economies do? Do they have to support this middle class now? But that actually blows up entirely the economic logic, which actually foregrounded the European market economy, the European capitalist. Right? Or you leave them aside, and then in this case, the level of instability will increase, because for decades, for centuries, the middle class constituted the point of stability, of the political stability. And that's not pretty clear to me. And now we see, we observe elections, for example, in France, the local municipal elections.
Yeah.
And we see that the crushing defeat for the mainstream party, for Macron's party at the elections, which actually already is a sign that a political change might occur, which doesn't necessarily mean that populists would replace Macron, does not necessarily mean it, but it's a clear sign to Macron in the case of France, that the political crisis is there. And in addition to that, quite interestingly, Macron betted on the fact that there's going to be political renewal, that people will be more interested and more in politics and more confident in the political class.
He just has to find a way to stay in
And
himself.
basically we have the reverse effect.
You talk about support for the middle class. The US is a case in point. The last year, the paychecks that have been going to everybody, from those who really need it and to those who, as we know, do not need it. And obviously, that's a much bigger equation. And Europe hasn't quite done that, which is probably a good idea because, as you said, how are you going to reverse that when the time comes? Just we've got a couple of minutes left, just to kind of look forward to the week ahead. Rustin, I'll go to you, please, on this. Projections for the market, in terms of where the price might go in the next few days. Have we kind of stabilized in this sort of early to mid 70s range, or do you see some more impetus as we get to the July 1st OPEC meeting and, of course, heading into the second half of the year?
Well, I think it's going to really depend on how things settle here this week. Right now, if we stay above $75 and settle above $75, that does open the door to an $80 move on a technical basis. I think that coming into the end of the quarter, I'm always cautious of any type of volatility going into the end of the quarter, just as funds tend to try to close out positions as they have to remediate fund money to people who want to withdraw money from their accounts. So there's usually a rebalancing of fund positions as they come into the end of the quarter, and especially with the massive move we've seen in commodity prices, it wouldn't surprise me to see a pullback, say, closer to $70 before the end of the month, then a move to $80. That being said, EIA data is going to be interesting to see today and how the market reacts to that. And
is the oil market at all watching these Fed statements? I know obviously they affect certain things like the dollar and obviously purchasing power of oil in that sense, but are they that bothered?
They all have, I think Andre pointed out to it that, as inflation goes up, cost of production goes up. It does impact demand at the end of the day because, all your financing and everything else that goes into the whole oil trade change does have an impact. We start talking interest rate increases, that does increase the price of oil at the end of the day to the buyer who has to finance that oil. If you're financing stuff at LIBOR plus 25 basis points, that's not too bad. But when you're now at LIBOR at 5% versus 1%, that's a pretty big move up on your final cost of goods. So it does add to the inflationary pressure.
Albert, I'll go to you for the last word and kind of going off the markets for a minute. And we did have a couple of stories that we didn't get to, which were on sort of energy transition. It's a big topic, not to sort of delve into it too much now, but there was a story about BP and Bernard Looney, who has been at the forefront, of statements of how, oil majors are going to transition into the energy transition and started to divest in upstream traditional oil and gas and more into renewables, etc. However, this particular story that we have up today is kind of, he's reassuring his investors that no, we're sticking to oil and gas for a while, don't worry, and we want to take advantage of this tightness in the market and lack of investment, if you like. What do you think is his purpose behind that, behind coming out with this statement today? He's been pretty consistent on the other front, and what does that mean for how quickly oil majors are moving and making this shift from your point of view?
Well, it tells me that he has factions within his shareholder group who aren't totally aligned on BP's objectives. What he said very clearly was that BP will emphasize quality over quantity. Right? So they are not aiming to be one of the world's largest producers. They're aiming to be one of the best in terms of financial performance. So that's, if that strategy holds and they follow that religiously, that's good news for BP shareholders. At the same time, he reinforced BP's intent to move aggressively into clean energy as well in the long term.
On just on the share price front, we've seen, obviously last year, all the main companies took a big hit on the back of the oil price and many other factors and demand projections. We've seen that recovery come back this year, and BP's share price, I think, is still sort of 30% below what it was pre-COVID. Your outlook for the recovery of those oil majors going forward, I mean, along with the oil price, will we back to normal by the end of the year in terms of share price and value? And
well, the majors in the oil industry, in fact, in the West, has always kind of followed the oil price in lockstep. So if recovery is in the cards for the majors, it'll be because of an aggressive growth in oil prices, and also an aggressive management of costs within the organization, cost and quality of assets. So there will be portfolio realignments, sales of some assets, purchase of others, that give them a stronger performance profile.
Okay, fantastic. Well, I'm afraid that's our time up for today. We had a lot of good comments on the chat. I'm sorry I didn't get to all of them. And I hope some of you read them. They were commenting on that. Thank you, gentlemen. Just to alert you to our halftime talk interview for this week, which is about, which will air at 12 o'clock today with Professor Yusra Mazzouri, Building a Gulf National Oil Force of the Future. A very interesting interview there with one of the leading ladies of the industry in the region. So I encourage you all to tune in. Thank you very much to Albert and Rustin and Andre for joining us today, and have a great remainder of the week, and we'll speak to you soon. Thank you very much for joining us.
Thank you, Diala. Okay.